But as bad as the problems are at the IMF, what happens in bank regulation, which is done in a committee called BASEL, is even worse. Because most people don't even know about BASEL. There is no system of accountability. It's basically accountable to the bankers. It's the central bankers and the other bankers deciding the rules for bankers. And so our banking system is basically a system of self-regulation. And self-regulation in general doesn't work. The reason we have regulation is because we believe that sometimes incentives of the private actors are not consonant with social interest. That's why we have regulation. And they didn't seem to understand this. The nature of the new regulatory system called BASEL II the nature of the self-regulation is that they told the banks that they should have risk management systems to manage their risks. Now, it's startling that you would need to have a regulation to a bank to manage its risk. You know, what else is it supposed to be doing? It's supposed to be, you know, how can it survive if it's not managing risk? Well, a lot of them aren't surviving. But the point is, you would have thought that would have been a primary aspect of their business models. So in saying that that was a regulation, what they were saying is, we aren't going to regulate you, in effect. Well, what was so obvious, and what should have been so obvious, was that bank self-regulation didn't work. Not only didn't it work, the other part of the bank risk management, bank risk management, was that we relied very heavily on rating agencies. And what we've now everybody recognizes is not only do the banks not know how to assess risk rating agencies didn't know how to appraise risk. But we should have known that, because in 1997 we had a financial crisis, and one of the things that was at the center of that financial crisis were the risk rating agencies. They failed very badly then, until, you might say, days before the Thai crisis, they were giving Thailand a AAA. Now, of course, when Thailand went into bankruptcy, they recognized that there was a problem, and they downgraded the rating. But in fact, as they downgraded the rating, they actually exacerbated the problem, because when they downgraded the rating by 2 grades or more very quickly, it meant that pension funds and other fiduciaries had to dump their ownership, because they're not allowed to have these low-rated bonds. And when they did that, what do you think happened? The prices plummeted. And so their forecast about low ratings came out to be correct. So they helped create the problems that they were describing. Well, in 2007 and 2008, the rating agencies lived up to the reputation they had in 1997 and 1998. Basel seems a little bit surprised. But why they were surprised is a mystery to me. In fact, if you looked at the incentive structures of the rating agencies, things are even worse. The rating agencies were being paid by the banks who were giving them these toxic mortgages and these complicated products to rate.